right, well, welcome to our Kenny and Kenny Best Practice Series. Today we're going to cover something that's timely at this stage of the year. So we're coming up on the middle of September, and it's a great time for a cash flow checkup, and then also to look at getting your ducks in a row with fringe benefits. So I'm going to be your guide. I'm going to take you through both of those. And so with that, let me begin. I'm going to share my screen. Okay, so thank you for joining me. And legal disclaimer, we've made every effort to prepare material that's accurate and timely, and you're welcome to use it. But if you're going to use it, we do ask that you let us know. A little bit about our firm. We're a partner, your partner without equity. We are all about helping our clients lead fulfilling lives financially, and we want to support them and businesses at all stages. Worthwhile plans take time to realize, so we can help with those client plans in creating them with the client. You're the expert on your business, and we bring the financial expertise, so the two of us together can create a plan that fits you and your business. So with that, today's agenda, again, we're going to talk about a cash flow checkup with Profit First. We're going to look at fringe benefit reporting, and then we'll have time for a question answer session as well. So let's dive into the cash flow checkup. Now, the ultimate methodology for cash flow is really Profit First. That's a book that Mike Michalowicz created 10 years ago, and he's trained a number of Profit First professionals like myself on the methodology, and it's really awesome. I think it's very similar to QuickBooks for accounting systems and small businesses. So it's something that works for entrepreneurs. It's easy for them to understand, and it's a great way to evaluate how your cash flow has been managed leading up to this point in the year. And September is a good time to run a checkup like this, because you still have a few months to go, and you can always make a few tweaks if you need to make an adjustment. So here's why, a couple more reasons on Profit First. So if you've read the book, you know that the formula is different. It's revenue less profit equals expense. So we'll get into the details on that a little more later. However, think about it. The normal formula is revenue minus expense equals profit. The problem is there's generally not profit left over unless you adopt a methodology like this, where you make profit a priority. In fact, you make that the first allocation of the revenue that you collect in your business. So, and when you create more profit in your business, you create more value down the road when it comes time to sell. So let's take a look at how this works for different size businesses. What you're looking at now are target allocation percentages, and you'll see columns which are based on revenue. So starting in the far left, you'll see that we've got a small business, 0 to 250,000. And then on the far right, we've got a business with 10 million to 50 million. And so these are completely different businesses. And if you look at the percentages, you'll see that they're quite a bit different. So the profit allocation is 5%, owner comp is 50%, tax is 15, operating expenses is 30. So in this type of business, generally it's only the owner. The owner is doing everything. They're generating the sales, they're closing the sales, they're performing the work. And so owner comp is going to be the main expense. And operating expense is going to be less because they're the only team member versus a business on the far right, which is profit 17% and owner comp 3% and operating expense 65%. So the reason, as you can imagine, at 10 million plus, this is going to be a substantially larger business than the one where we've got the 0 to 250,000. Now, how this works mechanically or logistically, we're going to look at this example. So this is something that we do with our clients on a quarterly basis. We put their numbers through a lens like this. And so in this business, we're looking at 12 months and it's $1 million. If we go back to the target allocation percentages, you'll see the percentages for $1 million are right here. So we've got profit of 10%. And so that is the target. So when a dollar's collected, 10 cents is allocated to profit and moved to the profit account. 10 cents is allocated to owner comp and transferred to the owner compensation account. The profit distributions come out of the profit account, owner comp comes out of the owner comp account, taxes are paid out of the tax account, operating expenses are paid out of the OPEX account. Now, in an ideal world, the business is hitting those targets or they're better than the targets. In this case, we've got quite a different story. And this is a story that I'm used to seeing, especially with clients that are not fully adopting profit first. You can see that the profit distribution was only 2,000. However, if they had fully implemented profit first, they would have received a distribution of 100,000. So much worse and plenty of incentive to adopt profit first. Going down, same thing, owner comp. Unfortunately, that's substantially less as well at 80,000. Tax, this is a huge problem. They didn't allocate anything to the tax account. Hopefully they don't owe 150,000 at the end of this year. I suspect not, because they only had 2,000 of net income or actual profit after the operating expenses. And so let's say that they had allocated to the tax account and they don't need all of those funds for taxes. That would just be available for an additional profit distribution, which only enhances the value of adopting profit first. They've got some additional items here like employee benefits and an emergency fund. Basically, if there is an intention for the business or business owner, like a big piece of equipment, we can always set up another account and take some of the percentage out of the operating expense and put it to that account. So we, in this case, have done just that with employee benefits and the emergency fund. So whenever a business doesn't hit the profit targets, it's a sign that their operating expenses are too large. So in this case, we see just that. The operating expenses are probably 97%. So the opportunity is to lower the operating expenses so there's dollars available to allocate to profit. But as a business adopts profit first, those percentages don't just start out at the targets. We start out at a manageable target or allocation to profit first, and then we're spending time with the owner, analyzing the expenses, looking at the ones that can be replaced for cheaper options that deliver the same value to the business. We're looking at expenses that can be completely cut. They're unnecessary. One of the things that we see time and time again has to do with subscriptions. Could be a piece of software they used 5 years ago. They didn't realize that they were still on subscription. So those are great opportunities to enhance the performance of the business on a cash flow basis. So as I mentioned, Profit First came out something like 10 years ago. And over that time, there's been a lot of Profit First professional feedback. And they've used that feedback to determine the most success is attained when the business works with a Profit First professional and we're able to implement on a really fast pace where we're implementing within 5 days. I want to say that you can implement in 5 days. You may not be at the targets yet, but the quicker you implement, the more likely you are to succeed at fully implementing Profit First. And you saw what that can do as far as creating profit distributions, in this case for $1 million business of $100,000. So now let's look at fringe benefit reporting. Fringe benefit reporting is very timely in September. So we're in the third month of the third quarter. So we need to get ready for the reporting requirements with fringe benefits before the end of the year, because a lot of times those are going to impact owner and employee W-2s. So with that, let's talk about why fringe benefit reporting is important. So first off, in an IRS audit, it's one of the first things that they check. They're going to look at fringe benefit deductions. They're going to look at whether they're legitimate. And so part of that has to do with ERISA compliance, which ERISA stands for Employee Retirement Income Security Act. And I'm going to show you in a minute why that's significant. We all know why the Internal Revenue Code is significant and why the IRS is quite a motivator for doing things right. So ERISA should be even more. These penalties are extraordinary. Now, criminal penalties for individuals of up to 100,000, companies up to 500,000, civil penalties equal to 20%. These are mind-blowing. And they apply to health benefits. They apply to retirement benefits. And I'm not looking to create extra anxiety for a business owner. You've got enough, but I do want you to put this on your radar because it needs to get done right. And so in order to comply for a retirement plan, you've got to perform these type of duties. So there needs to be a plan document that's consistent with the ERISA rules, and they can't favor the highly comped more than the lower comped. You've got to offer plan diversification. and have reasonable plan expenses. Those are some of the factors in determining whether you're in compliance or not. Now, this is your key professional here, the third-party administrator. They are invaluable for a small business. I say that as a CPA who's been practicing for over 35 years. Any client that wants to implement a retirement plan, we will give a referral to a TPA, and they keep ERISA at bay and handle all the compliance. They are worth their weight in gold. And if you have a good one on board, there's no reason to worry about this. They're going to help you comply, but take it seriously. The potential for penalties it's extraordinary. There's other benefits this time of the year to kind of get your ducks in a row on. And these are ones that include mileage, because if there is a company car, and just for practicality, unless the car is driven more than 50% of the time for business, and that doesn't include a commute, you're going to need to keep mileage logs, and you're going to need to report that on an annual basis to calculate how much of the benefit that was provided is personal. And the personal portion gets calculated and then added to the employee's W-2. And that those employees include the owner of the business. Next, life insurance. So we want to make sure that the company isn't deducting life insurance or disability, because if they are, then you're undermining the value of that benefit by getting a tax benefit. So that would potentially make the benefits, when they're paid out, taxable, which is the last thing you want to do. You're paying a lot of money for that coverage. Health insurance. This is vitally important for S corporations and pass-through entities. If the owner has health insurance provided by the business, you want to make sure that this is added to the W-2, because if it's not, then you're not able to get the benefit for that health insurance deduction. So we've got a little extra time for Q&A. We'll see if we have any questions. I'll give it a minute. And the plan is to upload this recording to our website, so you'll have access to that, and you can always email us and let us know if you have any questions on this content. But thank you for coming, and we look forward to seeing you next time.